Whenever the crypto market pumps or dumps, everyone asks the question, why?
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 Why? Why?
The short answer is almost always because BTC is pumping or dumping. Where BTC goes, the rest of crypto follows. This begs the question of what causes BTC to pump or dump. A recent report from one of the best crypto research firms has all of the answers. Answers that can help you predict the next big market move. That's why today, we're going to summarize this report and tell you how you can use its findings to get an edge in the crypto market. If you hold crypto, this is a video you cannot afford to miss. The report we'll be summarizing today is titled The Forces Moving Bitcoin. It was published by a crypto research firm, K33, and we'll leave a link to the report in the description. I'll quickly note that to access the report, you need a pro account, and Coin Bureau Club members get a 50% discount. Anyhow, the report begins with a brief introduction where the authors explain that the purpose of this report is to present a framework that determines what causes BTC to pump or dump. Notably, this framework accounts for the fact that some of these factors change and interact with each other. However, the authors caution that it is theoretically impossible to predict BTC's price action with 100% certainty, and that there could be other frameworks that are much more accurate. Even so, the authors believe that their framework serves as a good starting point for figuring out what makes BTC's ticker tick. This ties into the second part of the report, which seeks to set a foundation for the author's framework. The authors underscore the fact that BTC is not only scarce, but its supply is predetermined by Bitcoin's protocol rules. This makes it different from other assets, which have less predictable supply dynamics. In the third part of the report, the authors serve up the meat and potatoes. What determines BTC's price? The short answer is multiple factors. And what's interesting is that the authors look at these factors through the lens of momentum, specifically how they increase upward or downward price action. They again highlight the fact that these momentum factors can interact with each other, and they often take turns being the primary drivers of BTC's price action. The authors group these momentum factors into three categories: demand factors, supply factors, and structural factors. By the way, if you're enjoying the video so far, be sure to smash that like button to help others find it and enjoy it. And subscribe to the channel and ping the notification bell so you don't miss the next one. Now, when it comes to demand factors, the authors note that BTC's inelastic supply makes the demand side of the equation the most important. Within this equation, the authors identify 6 factors: sentiment, news, utility, macro, cyclicality, and accessibility. Starting with sentiment, the authors further divide this factor into 3 camps: long-term BTC holders, institutional investors, and retail investors. The sentiment of long-term BTC holders can be assessed using on-chain analysis. For institutions, it can be assessed by analyzing the trading of BTC futures on TradFi exchanges like the CME. And for retail investors, it can be assessed by looking at stuff like web traffic. Not surprisingly, long-term BTC holders tend to sell when sentiment is high and buy when sentiment is low. Also not surprisingly, retail investors tend to be the biggest drivers of these sentiment moves, as they buy when the prices are high and sell when the prices are low. On that note, the authors reveal that retail trading activity on Coinbase is still very low and is at levels similar to the beginning of the previous crypto bull market in late 2020. This suggests that retail investors haven't really arrived yet, and that the current crypto bull market is about to enter its parabolic phase. More about when altcoins could pump using the link in the description. But back to the 3 camps of the sentiment factor. Remember that institutional investors are in the 3rd camp. Now, what's fascinating is that BTC's price tends to follow whatever institutional investors are doing on TradFi exchanges like the CME. In other words, they are ahead of the curve. Naturally, the authors note that all traders should therefore pay close attention to changes in things like open interest for BTC futures on the CME, as well as spot Bitcoin ETF inflows and outflows, as they can potentially predict how BTC will perform in the following hours or days.
We interrupt this program for an emergency crypto weather forecast. Get ready for a whirlwind of savings. We're seeing a high-pressure sign-up bonus system forming in the Northeast, with some exchanges offering up to $60,000. Lush. In the South, we'll be seeing some heavy discounts on hardware wallets, so watch out for those if you're going to be out and about. And then, over in central areas, there's a high chance of trading fee discounts, which should be setting in later on, up to 60% off there. Amazing! For a more comprehensive forecast, visit the Coin Bureau deals page using the link in the description. These deals are red hot, so make sure to take all necessary precautions. That's all for the forecast. Now back to our scheduled program.
Now, the next factor in the demand bucket is news. The authors recount how BTC hit local tops around major announcements, such as the launch of the Bitcoin Futures ETF in October 2021. They acknowledge that the approval of the spot Bitcoin ETFs seems to be one of the only exceptions. On the flip side, BTC has historically hit local lows during Black Swan events, such as the pandemic flash crash of March 2020. It's safe to say there are no shortage of black swans out there these days, but so far none of them have bitten BTC. Touch wood. Now, next we have utility. The authors admit that BTC doesn't have much utility these days beyond being a store of value. From our perspective though, it is possible that BTC could once again be used for payments, this time in international trade. Some countries are reportedly using BTC for this already. After utility, we have macro. The authors accurately point out that BTC's susceptibility to macro factors ultimately depends on its correlation to TradFi assets such as stocks. Given that BTC's correlation to stocks has come down, it's likely that BTC is less affected by macro factors, black swans notwithstanding. To be clear, this doesn't mean that BTC isn't affected by macro factors at all, just that its price is affected less. This is something the authors stress, and they also stress that understanding which macro factor is moving BTC's price can be very difficult. This is an understatement, given all of the geopolitical uncertainty floating around these days. Anyways, cyclicality is the next subcategory of demand. Oddly enough, the authors don't provide much detail here. They just note that when the crypto FOMO kicks in, BTC tends to underperform from the rest of the market, as everyone sells BTC for alts and meme coins. When the crypto FUD is still fueling sentiment, everyone flocks to BTC for safety, causing it to outperform other assets. Now, some would argue that the spot Bitcoin ETFs have affected this cyclical trend, but let's not go there. Now, the final factor in the demand camp is accessibility, which is arguably the most important factor of them all. After all, if investors can access BTC, its price won't pump, regardless of the demand. This is something the authors emphasize as well, as they note there are two ways to access BTC: natively through crypto exchanges and the like, and by proxy via ETFs and the like. The authors point out the elephant in the room, and that's that there's a lot of pent-up demand for BTC from institutional investors who are waiting for the spot Bitcoin ETFs. Now that these have been approved, these investors have started buying, and because spot Bitcoin ETFs are backed by physical BTC, this has resulted in big BTC buys that move the market. Now, in the second part of the report, the authors unpack the supply-side factors affecting BTC's price. They start by saying that BTC has a maximum supply of 21 million, and that new BTC are mined every 10 minutes. Of course, they note the number of newly mined BTC is cut in half every 4 years. Obviously, the Bitcoin halving is the first supply-side factor. What's not so obvious, however, is the second factor, and that's lost and returned BTC. The authors use the defunct Mt. Gox crypto exchange as an example. 142,000 BTC will be returned to creditors and will apparently be locked for 10 years. Regarding the halving, the authors note that right now around 900 BTC are mined per day. After the halving, expected on the 19th or 20th of April, only 450 BTC will be mined per day. Just to put things into perspective, the authors note that BTC's inflation rate is currently akin to gold's, specifically around 2%. After the halving, BTC's inflation rate will be less than 1%. The authors hint that continued demand from the spot Bitcoin ETFs, combined with the reduction in newly issued supply, could lead to substantial gains for BTC. They actually predict that BTC will grind higher into the upcoming halving. That's simply because speculators will likely try to position for this key crypto catalyst, or rather, what comes after it. The authors know that the crypto bull market tends to occur in the year after the halving, and that speculators will try to price that in. Historically, this has translated to 14% gains pre-halving. Funnily enough, the authors don't seem to say anything definitive about BTC's price immediately after the halving, just that the supply reduction eventually leads to higher prices. Our research suggests that BTC's price immediately after the halving could be neutral to negative, based on the past halving cycles. This is presumably because the speculative bubble deflates and BTC reverts to the mean. In any case, regarding lost and returned BTC, the authors remind the reader that Bitcoin creator Satoshi Nakamoto is believed to hold 1 million BTC, which could, theoretically, be sold at a moment's notice. They admit that this is very unlikely, but that BTC still has other, much more probable supply shock risks. Besides the return of BTC from Mt. Gox, the US government still holds around 200,000 BTC it seized from the Silk Road Darknet marketplace and the like. The authors note that around 111,000 of this BTC is expected to be sold, and they remind the reader that the BTC sales that were planned last year never happened. Probably nothing. Anyways, the authors also touch on the fact that 96,000 BTC from the 2016 Bitfinex hack are expected to be returned to the exchange, and that the exchange will use 80% of this BTC to buy back and burn its Leo token. So far, though, only a small fraction of hacked funds have been returned to Bitfinex, which is Tether's sister company. Also, probably nothing. Anyhow, in the third part of the report, the authors tackle the third family of factors affecting BTC's price, which you'll recall are structural factors. They identify 7: portfolio rebalancing, management fees, treasury strategies, leverage, carry trades, cyclicality, and Bitcoin miners. Beginning with the portfolio rebalancing, the authors explain that as BTC starts to get introduced to institutional portfolios, it will be bought when it underperforms and sold when it outperforms, per the rebalancing strategy that many institutions use. This could limit BTC's volatility, but also increase its correlation to TradFi assets. Some would say that this is happening already. Regardless, the next factor is management fees. The authors point to another elephant in the room, and that's Grayscale's Spot Bitcoin ETF. For context, it has the largest management fees of any ETF by a wide margin. These management fees are likely contributing to the outflows from its ETF. The thing is that this isn't unique to Grayscale's Spot Bitcoin ETF, at least not in the way that you think. You see, to pay these management fees, the asset managers periodically sell some of the ETF shares, which in practical terms means selling small amounts of BTC. For reference, the authors use Grayscale's GBTC trust, which was selling 32 BTC per day as part of its management fees. Thankfully, the fact that everyone is switching to using low-cost ETFs means that the amount of BTC being sold as management fees each day will decline to around 6.5 BTC per day in total. When it comes to cyclicality, meanwhile, in this case, the authors focus on taxation. They note that after a big year, investors may have large capital gain bills that they need to pay off and imply that this can result in sell pressure in the short term. Come to think of it, it's possible that this is why crypto has been selling off lately. Whatever the case, the next factor is treasury strategies. The authors rightfully point out that Tether has been one of the biggest contributors to this factor, and it committed to purchasing BTC using 15% of its net profits last May. Since that time, Tether has bought tens of thousands of BTC, creating a sort of structural support for its price. The authors note that Tether's BTC buys also make it a counter-cyclical force, because the more the interest rates rise, the more BTC that Tether can buy. For those unfamiliar, BTC typically declines when interest rates rise. The catch is that this assumes that USDT's supply doesn't shrink, and that it likely would if rising rates would bring down the rest of the market. Most USDT demand comes from trading. Speaking of trading, leverage is another crucial structural factor affecting BTC's price. The authors reveal that retail investors are the main parties using leverage to go long or short, whereas more experienced participants, like market makers, often take the other side of the trade. They also repeat something that regular Coin Bureau viewers should know, and that's the liquidations of leverage longs cause BTC to fall lower than expected, whereas short squeezes cause BTC to rally higher than expected. It's important to note that leverage plays a role primarily in short-term moves. Now, in terms of carry trades, the authors explain that this involves experienced market participants taking advantage of the discrepancies between funding rates for different trading instruments. In plain English, they will buy or sell BTC along with longing or shorting the current direction of the market when there's a discrepancy between spot and futures prices. Finally, we have Bitcoin miners, who often have to sell most of their BTC to fund their operations. The only two exceptions are when BTC's price is rising, a lot like it is now, and when interest rates are close to zero. In the case of the former, miners don't have to sell as much BTC as in the case of the latter, as they can take on debt instead of selling BTC. The caveat is that miners may be forced into selling more BTC after the halving if its price is lower, something the authors stop short of saying. History has also shown that when miners take on lots of debt, they run the risk of being forced to sell BTC to pay back these debts in the future, particularly when interest rates are rising. Now, in the fourth and final part of the report, the authors provide a few examples of how you can use their framework to trade BTC. They provide this handy infographic, which shows you how all of the factors in the framework have affected BTC's price over the last 4 years by their estimation. They then provide a breakdown of how these factors affected BTC's price each quarter in 2020, 2021, 2022, 2023, and 2024 so far. For the purpose of this video, we'll stick to the 2024 analysis, as it's the most relevant. So far, only 1 quarter has passed, and the only negative factor seems to be leverage. As you might have guessed, the authors note that retail investors are to blame, and that a good chunk of the upside and downside volatility that we've seen since the start of the year is because of their reckless leveraged trades. Fortunately, all of the other factors appear to be positive, save for macro, which is not noted as a negative for some reason. What's even more fortunate is that the authors forecast that most of the factors in their framework will be positive in the remaining quarters. The only exceptions are leverage, which the authors note as being an ever-present short-term hurdle, and also uncertainty around macro factors, which I just noted. Unfortunately, the positive factors may not be as positive for altcoins. That's because the market structure in the altcoin market has changed. For example, US and UK users can no longer access the offshore exchanges, where the most promising altcoins are traded, and users in the EU will experience stablecoin restrictions starting in July. This brings me to the big question, and that's how you can use the findings of this report to get an edge in the crypto market. The answer is to be aware of each factor and how it's affecting BTC's price, and in turn, being aware of how BTC's price tends to affect the rest of the crypto market. To recap, there are 3 categories of factors: demand factors, supply factors, and structural factors. The demand factors are sentiment, news, utility, macro, cyclicality, and accessibility. The supply factors are in the halving and lost and found coins. Structural factors are portfolio rebalancing, management fees, treasury strategies, leverage, carry trades, cyclicality, and miners. As the authors noted throughout this report, BTC's short-term price action is the most affected by factors where retail investors play a big role. This means mainly sentiment, news, and leverage. The other factors seem to pertain more to BTC's longer-term price action and to institutional investors. There is one important exception though, and that's macro. If there's some big macro factor that spooks institutional investors, this can likewise have an immediate effect on BTC's price action. The recent spike in oil prices is the perfect example. It caused crypto and stocks to slump, with crypto being dragged lower because of the retail sentiment and leverage. Logically then, if you're looking to get an edge in the crypto market, you need to focus on retail sentiment. Think about how certain headlines are likely to affect retail sentiment and how prices could be impacted by leverage. In the case of altcoins, you need to factor in accessibility for the reasons that I mentioned earlier. Assessing retail sentiment can be done using various sentiment indicators, though the best one of all probably is what's being said on crypto Twitter. The same thing is true for assessing how retail investors are reacting to certain headlines. As for the leverage, this can be tracked by looking at liquidation heat maps. These show you roughly where lots of longs could be liquidated and where shorts could be squeezed. Note that we'll leave a link to all of these resources in the description. Now, assessing accessibility for altcoins is straightforward. It looks like, during this cycle, most of the altcoin speculation will take place on more regulated exchanges, such as Coinbase. That said, there's also been lots of retail activity on DEXs, and it's possible that regulation of CEXs will result in more DEX usage. So don't forget about how much macro factors could impact the crypto market. Keeping track of these is admittedly more difficult, as it requires quite a bit of expertise. One shortcut you can use is to listen to podcasts featuring macro experts. Just make sure you're getting a wide range of opinions. Lastly, factor in the extra volatility that altcoins experience relative to BTC. As a rule of thumb, altcoins are between 50 and 200% more volatile than BTC. That means if BTC pumps, most altcoins will eventually go up by 50% to 2x more. And the same is true if it dumps. Altcoins tend to perform the best when BTC is trading sideways, which we haven't really seen yet. By keeping track of sentiment, current and potential future headlines, leverage, accessibility, and macro, you should be able to get an edge in the crypto market that most crypto investors and traders don't have. Now, this doesn't necessarily mean that you'll become a millionaire, but with enough practice, you might learn enough to lose less money. And that's all for today's video. If you learned something new, smash that like button to let us know. If you want to keep learning, subscribe to the channel and ping that notification bell. If you want to help others learn about what moves BTC's price, be sure to share this video with them. And as always, thank you so much for watching, and I'll see you in the next one. Until then, crypto friends, this is Jessica, over and out.